All right. Well, good afternoon, everybody, and welcome to our third Thursday at 3. I'm Greg Spaeth, Chief Strategy Initiative Officer here at E4. We've got a really good event today. I'm really excited about this. A few housekeeping items before we get started. This webinar is set up that everyone can actually interact with each other using their cameras and audio. Everyone can start by just staying on mute. So if you guys look on your toolbar, there'll actually be a mute button. Make sure that you are on mute. But if you do have a question, there is a hand that you can click on that will allow for us to ask questions. We would ask that you come off of mute, or you can actually use our chat feature. I will be monitoring that, and I will ask those questions when I think we could probably appropriately answer those, or we'll wait until the end and we'll ask for some questions. So let's go ahead and get started with repositioning wealth. Tax efficiencies or strategies for modern retirement planning. Today, I'm very excited to have with me Bill Anderson and Nate Weathers, both RVPs here at E4 Insurance Services, to help show you how to discover a practical real-world framework for helping clients reposition assets more tax efficient in a potential unpredictable tax environment. They're going to do two things for you today. One, Nate will actually show you how to discuss the approach of different asset classes in a way that clients can easily understand. And then he's going to hand it off to Bill, who's actually going to go through a visual, as we like to call the cylinders of money, as it actually compares solutions through the accumulation and distribution phases. Nate will start with the simple client approach, then hand it off to Bill, who literally has helped create over $700,000 of additional revenue for advisors that he works with this exact presentation. So with that, I'll hand it over to Nate. It's all yours, buddy.
Greg, thanks for the introduction. And by the way, that 700K is all in the first quarter of this year. So Bill, congratulations there. Thanks. Guys, hey, good afternoon. Thank you for being with us. I want to use just a process that just actually works. I know that we all have talked about the national debt. Hopefully that is a topic of discussion, unfortunately, that you have every day. But the real challenge is that not only is it 38 trillion and climbing, but there are unfunded liabilities of $107 trillion. If you don't understand the importance of that, there's more taxation to come is the simple answer. A projected $84 trillion worth of wealth transfer from baby boomers to their heirs by 2048. Cerulli Associates, if you don't know who Cerulli Associates is, it's really important that you do. Most of us use this as a widely respected research and consulting firm for all of our investment advisors, carriers, and industry trends as we look into this data to make sure that we're building the right products and also designing the right solutions for you to present to your clients there. So they have given us that additional projection of 124 trillion in wealth transfer, and alongside some governmental changes and really some potential policy drivers that may reshape estate tax legislation, we've got a problem. And so today's simple way of communicating this at the table with your clients is really going to help you. I hope you will take some notes here. I think it'll be encouraging to use this in your daily practice because honestly, you know, the clients want simple. They do not want something that is difficult or complicated. And so many times we run into advisors, Bill and I both sit at the table with you and your clients. And so many times we hear you talk about taxation, but that's kind of the end of it. So this gives you an opportunity to use a method that we've seen over the last 20 plus years that's just really simple, something that they can actually put in their pocket or their purse, take home, and actually know that they've done some good planning with you there at the table. So if you're focusing just on growth, I really do believe that you're missing half of the opportunity to serve there. The other half is really protecting that growth from tax degradation. So like Greg said, I'll give you an overview, and then my friend Bill will give you some additional context to use. By the way, just hone in on these, and these tools will actually help you build your book of business better. If you have any questions, obviously Bill and I will be available after this call to handle anything that you have there. Bill, will you hit the next slide for me there? All right, so as you look towards using this tool, it is a T chart. So I encourage you to visually draw a T. We're going to talk about the flow of where these areas of taxation occur. And the first one is taxable. These, as you know, there's really about 3 quadrants of savings that you can talk to with your clients. And our goal here today is really just to identify where those clients' assets are currently. That's something that you do in day out, and really how it affects their retirement and their income as they age. So the first one, as you know all of these products, you know all of these solutions: CDs, stocks, corporate bonds, savings accounts. These can be taxed as obviously capital gains or as part of ordinary income. But if you don't know, the current highest capital gains tax rate is not just 20%. It's actually 20% for the top long-term capital gains rate, plus an additional 3.8% on investment income. I know you know that if you're watching this, but if you don't, 23.8 is that top capital gains rate. So the question there is, what percentage, Mr. and Ms. clients, of your assets do you have in this taxable box here? Then we go to tax deferred. Obviously, there are several things that can grow tax deferred. You've got traditional IRAs, you've got your 401k, 403b, 457, annuities and pensions. But you also need to be aware that these are taxed as income as well at ordinary rates, which can be as high as 37%. So the question there is very simply, what, Mr. and Ms. Client, do you have in this box? And so you're formulating a kind of a percentage. You've got a percentage in your taxable quadrant, you've got a percentage in your tax deferred quadrant. And of course, the last one that we're going to talk about is tax free. And as far as I know, there's really only 3 areas that you can put money in that is tax free. And this is above the red line. You'll notice visually that line is red or orange. I'm not sure what color that is, but it gives you the ability to visually make a delineation between the taxable, the tax deferred, and now the tax free. So now we've got the municipal bonds, which, as you and I both know, really aren't keeping pace with inflation, but could be an option down the road. We've got the Roth IRA, which I love, great vehicle, but you do need to be aware of its limitations. If you make too much, obviously you can't use it. You're restricted on how much you can put in. You may be penalized, obviously, if you take out distributions before 59.5. And most importantly, where are most of these funds invested? They're invested in the market. So there's potential volatility there. Not to beat up the market too much. We've all made some good money in the market, but that is a risk. And as you have clients that are worried about aging and what their money is actually doing, then you do want to make sure you have that discussion about volatility. What I want to bring to you today is 7702 planning. 7702 planning is really important to us in the industry. And we find as books of business continue to age, the more advantageous it is to use some of these products there. So this plan specifically does not restrict income limitations. It does not limit you on how much you want to put in. It does not penalize you if you want to use it before 59.5. We love that. And it can give you also principal protection. We call it buying dollars for pennies, if you will. It's really everything that a Roth is not. So if you are aware of the major tax codes, then you know 7702 as well as you do 401k, 403b, 457. If not, would love to talk to you about 7702 and make sure that you understand how to think proactively about your clients' futures in these categories. So the bottom line here is, what percentage of your clients' assets are in tax-free vehicles? That's a fantastic question to ask. And many times you'll find that very little or even zero are in some of these other tax-free vehicles. So this, of course, helps you reposition some of those assets as you have those very important conversations with your clients. So I hope this visual has been a help to you. I can give this to you after the call if you'd like to see it again. But let's get started with some more context, Bill. Tell us about the details here within this plan.
Sure, yes. Sorry about being a little behind on the clicking the button for you, Nate. I will share with you that this is a wonderful napkin exercise, right? And what I'm going to share is pretty much on a yellow pad. You can't quite squeeze it all onto the napkin, right? But we call it the cylinders of money. And what we're really doing is we're looking at different cylinders, call it asset classes, places that people can save money. And we're looking at them from 4 elements: contributions, accumulations, distributions, and trade-off. Now we're going to start on the first cylinder, which is qualified money. We have pre-tax contributions. It accumulates tax deferred. Distributions, of course, are ordinary income taxable. And trade-off, you can't get at them till 59 and a half. And then at RMD age 73, you have to start taking them. The next cylinder that people usually start to save money long-term is in a non-qualified portfolio or non-qualified money, where you're putting in after-tax money. It accumulates with tax, it distributes with tax, and it's liquid. This is a wonderful account until you get to somewhere between $250,000, $500,000 of size, and then the tax freight of the accumulation and the distribution starts to really penalize your clients. So we start looking for other things. Nate just mentioned tax-free bonds. How do they work as a cylinder? It's after-tax contributions, accumulations are tax-free, distributions are tax-free. For the trade-off, it's somewhat liquid. And Nate, you made a good comment in there. Does it really keep up with inflation? Barely. And kind of what that vehicle does, right? If you're in a high tax state, people in the Midwest around Minnesota, as an example, munis can still look pretty attractive. Next cylinder, non-qualified annuities. Some people like them, some people not so much. Bottom line, here's how they play out here. Contributions are after tax. Accumulations are tax deferred. It's a power of that whole deferred annuity concept. They are tax favored when the money comes out, and you basically can't take them until 59 and a half, but there is no 73 RMD age. If you just want to let them grow and become a wealth transfer vehicle, you can. Let's look at the taxation on these. It's called last in, first out, or LIFO accounting on non-qualified annuities. Let's say you put in 100 grand through the years, it grew to 250. So you've got $150,000 of growth and you want to tap into it. Well, last in, first out means you're taking the growth out first, 100% income taxable. You don't get to remove that after-tax basis, if you will, or tax-free, I should call basis, until all of the gain has been removed. As you are aware, if you understand annuities, you could annuitize it and spread that gain out over a period of years. But last in, first out accounting. Back to the cylinders. How about real estate? Real estate can be really looked at 2 ways. First way is kind of your buy and hold, buy the cabin up in the mountains and just hold on to it. The other one is your investment real estate, rental income, that kind of stuff. Well, we're going to use the buy and hold strategy, the cabin in the mountains. So you're basically looking at contributions being after tax, accumulations being tax deferred, distributions being taxable but as capital gains, and like the tax-free bonds, it's kind of liquid. However, I own property in Florida. We bought a house in Florida 4 years ago, and then we just built a house. Well, this is what happens with real estate. It's kind of illiquid at times. It's become a rental for us. Welcome to being a little upside down, right? But let's talk about life insurance, because this really is a very attractive tool if it fits into your numbers in your portfolio. So let's start off how people purchase life insurance, or sometimes what I like to call how it's sold. High death benefit, moderately growing cash value, difference between those we call the cost of insurance. If we are talking about an alternative asset class, we do not want to design our insurance this way. Rather, we want to design it with a very low death benefit that grows, that gets pushed up by a very fast growing cash value. The difference again being your cost of insurance. And when we can prove mathematically, well, before I get there first, don't do it this way. Do it the side on the right, right? But we can prove the cost of tax of other vehicles is more expensive than the cost of insurance, then it becomes an idea, right? So let's grid this out. Contributions are after tax. It accumulates tax deferred. It grows, or I'm sorry, it accumulates tax deferred, distributes tax free, and it is liquid, but you need to have 7 to 10 years of time on your side for that tax deferral to really make out. As we all know, insurance has fees and charges. And if you do one of these plans for 5, 6 years, you're not going to have enough deferral time on top of the fees and charges of the insurance to have this pan out. But if you're in there for 10, 15 years, the math is really wonderful. So let's look at the tax treatment. It's called first in, first out with life insurance. Same 100 grand you put in, grew to 250, got $150,000 of growth, and you want to take out 200 grand. You get to take out your basis first, tax-free return of principal, and then on the growth, you're actually taking a loan on your own money. The real why this works, it's kind of like borrowing money and paying yourself interest on your 401k if you've ever had that option. This is what we call a wash loan. The carrier will charge you 4% for loaning out the money. They'll credit you back the same 4% contractually guaranteed, so that there's a 0% cost to loan out your own money. So back to the cylinders. Which one of these cylinders is best? And literally, when you're in front of a client and you ask them this, they go, I don't know. Maybe it's a life insurance one. Maybe it's something else that they're doing. My argument has always been, I think the best one is the one on the left. It is so good that the IRS limits how much you can put into it. But it's really about this. It's about that third row. What are the distributions? Wouldn't it be neat to get out to retirement and have some of your monies being, I guess, 100% ordinary income taxable, some of it being capital gains, some of it being tax-free and tax-favored, and literally having money in all of these cylinders. When I draw this out on a yellow pad with you as your advisor and your client, you and your client as the advisor, say that's the right way. What we typically do is right on the top of each of these columns, we write in how much they have in each one of those cylinders so they can visually see it, right? And then here's what it looks like. Cost of tax versus cost of insurance. So we need to deal with underwriting. On a scale of 1 to 20, some carriers go A to Z. So you think that through. Table 1 or table A is perfect health. Table 20 or table Z is uninsurable. If your client comes in at table 3, can we design a plan such that the cost of the tax is less than the cost of the insurance in that relationship? And again, when we can prove this mathematically, then that column on the right-hand side becomes part of a recommendation for your client. So that's the quick yellow pad presentation. I love what Nate did earlier. Sometimes it's just a T chart or a couple buckets, and you're talking about all the tax benefits. This can be a wonderful tool. Greg, any closing thoughts?
No, just to the group as a whole, if you do have a question for Bill, Nate, or myself, you are more than welcome to unmute and ask that question. I didn't see anything come through on the chat feature. Just for the group as a whole, you can see how simple this presentation was. It took probably about 12 minutes for both Nate and Bill to go through this. So when you're sitting down with a client, it does make it a lot simpler for them to move through a presentation that's going to be concise, right? It's going to tell them where their assets, is going to give them the visual that they can walk away with. Bill, let me ask you this. What is the typical response that you get from the clients after you've gone through this? What is their typical response to you or the advisors that you're doing this with?
Yeah, I'd say the most common response is, how much can I do? Can I buy it? How much insurance do I get? And remember, we're buying the smallest amount of insurance possible. But when I've helped present this to professional athletes, musicians, those sorts of personalities, it's a 15-minute presentation max. And I oftentimes get that question, can I do more? And we have a conversation about financial underwriting, not just the medical underwriting piece. And people that make high incomes, a lot of money early in life, this is a very, very common strategy. By the way, goes by some other nicknames out there. It's 7702 planning. It's also called the life insurance retirement plan, supplemental retirement income plan, super Roth, those sorts of names. When you hear those, they're all talking about the same thing. And the other, to also answer that question, Greg, where can I learn more about it? It's like Google it, AI. You're going to see articles that are very positive and very negative. But we just showed you today how to design this thing the right way so that that story being written about it is always going to be positive.
Right.
Bill, a question came through. Can you kind of touch on who the ideal client is for this type of solution?
Sure. It's going to be, call it 35 to 55-ish or so. So they're going to be high income earners. They're usually maximizing their 401k. So they're putting as much away as they can pre-tax. If they're a business owner, they might have a SEP. They might be doing a defined benefit plan. Literally setting aside as much as they can pre-tax. And they're looking at you and asking you, how can I save more?
And then what do you do in terms of next steps for the client when they say, I'd like to move forward? How do you transition to the next steps for them to prepare them for what would be considered the health insurance side of it, the underwriting? How do you prepare them for that?
Yeah, I'm usually going to share with them that your advisor working with us at E4, we represent 40, 50 different carriers. Our job is to find the best product for you. So what we usually do is we do what we call an informal process. We like to call it exam first, and it really is that. What we do is we get the exam done, we get the medical records, we shop it to the different carriers, and they fight and compete for your business so that we can come back after a month and a half, 2 months, sometimes a little bit longer. And we're basically saying, hey, XYZ or ABC is the carrier for you. And what I like about that process best is that we can make that comment to the clients. Whereas if we just take an application with a given carrier, that carrier might not sharpen their pencils as much as they would if they did our other informal process way.
And I would say for the group as a whole, if you're looking at, hey, for my best clients, the best thing you can do is, I like to call it get under the radar when it comes to underwriting, because if you do an application, you submit it to the carrier, it goes to all the other carriers. And the approach that we have is we want to negotiate that as best as possible for your clients with the carriers. And we have some technology, AI technology that we use that helps position that the most efficient way, I believe, currently possible. So what might have taken us 4 to 6 weeks to get some answers back, we're looking at 4 to 6 days getting responses back through using some of the AI underwriting tools that we have available at E4. Other organizations don't do this, and I think they're missing an opportunity with that. Another question for you, Bill, are you running cost of insurance reports for these to go over with the clients, or just looking at the IRR to see the math make sense?
Yes and yes. So every one of these, I always make sure that we've got the policy charges report, because we want to have that conversation with the client, right? They need to understand when they get those quarterly or annual statements, where are these fees and charges and how the machine works, right? So it's literally, you're opening up the hood. I'm going to show you how the internal combustion engine works. And then the IRR report is really comparing the rate of return that you're illustrating with what the tax-free rate of return would be on those dollars over time. And we're going to be able to show a, what's the word I'm looking for? The Thursday, but it feels like a Monday for me. The rate
margin,
of return.
the delta. Yeah.
The delta. Yeah. Wow, I'm losing it today. But bottom line is what would be the taxable rate of return for that would equal that tax-free yield. So if you've got an IRR of 5% and your client's in a 40% state and federal tax bracket on average, but you do that 1 minus a tax bracket, divide it by it, and all of a sudden a 5% IRR is 8.5% for most people. And you can make the statement that we're illustrating these numbers at 6, but this is like you earning 8.5% in a 6% portfolio rate of return.
Great. Last question for both of you. How many times do you guys think you have done this type of presentation for advisors, clients? How many times do you guys think you've done that?
Couple.
You see the gray hair, so we all share that right now. So yes,
not
many
fair,
times.
Greg. Yeah.
So it would be fair to say more than just a couple.
Yes, sir.
Okay.
I would also step back, just talking about fighting for the client. We take that application very, very seriously. Not only do we shop it and have kind of the carriers battling for your client, we also use reinsurance. And that reinsurance allows us to go out and really have some leverage when we have a less than stellar underwriting class and say, because we've got this over here, we now have the ability to go over here and use this. So I think that's a very, very missed opportunity that most FMOs, IMOs do not have. And that gives us the additional, like I said, leverage and weight to really fight on behalf of your clients.
That's a great point. And the reason why I asked both of these guys, in terms of how many times, the reason why is, it flows really well for them. Bill, you can tell you've done this, your cylinders of money quite a few times. You flow very smooth through the process. And for the group as a whole, the importance that I'd say take from this is just practice makes perfect. Remember, we're here to kind of roll up our sleeves, personally with you, whether it's, showing you how to fish, teaching you how to fish so that you know how to fish with your clients. We're not here to just say, hey, here it is, go get them, Tiger. We understand that, it is a process. And if you make this part of your process, not only will you get more assets under management, you'll have a better retention with your clients because you'll understand that you're trying to reposition taxes more efficiently for them, to help them in the future. Because if they knew about this, right, they would want to move as much of the assets above that red line that Nate was talking about to a tax-free position. But that's not always necessarily the best thing. Diversifying that is always important as part of the discussion. So we wanted to thank you guys all for joining us today. Next month, our third Thursday at 3 will be held on May 21st, and we are going to be diving into E4 disability income case studies. So be some really good live cases that we've worked on and have closed to give you some real world examples. Again, we want to thank you for joining us. And if you have any questions or want to learn more, contact your RVP or myself or Bill or Nate, and we would be more than happy to help you. Make it a great rest of your day, and we'll see you later.